So right now, somewhere in America, there is a massive diesel truck
Well,
pumping thousands of tons of wet concrete deep into the earth.
yeah.
And it isn't building a skyscraper. It's not building a bridge or, some new suburban subdivision. It's actually building a fortress to house the artificial intelligence that you probably used this morning.
Right. And it is a fascinating juxtaposition, I think. When you think about the digital age, you think about, well, weightless things.
Right, cloud computing.
Exactly. Cloud computing, algorithms, lines of code. But none of that actually exists without millions of tons of reinforced concrete.
Right, which brings us to the subject of today's deep dive. We are looking into a company that literally builds the foundation of our world.
Literally.
Yeah, Concrete Pumping Holdings, Inc. They trade under the ticker BBCP. We've been going through their latest financial results, specifically their Q2 2026 earnings press release and the SEC Form 10-Q from June 4th.
Which, I mean, normally you might think an SEC filing for a concrete company would be incredibly dry reading.
Oh, absolutely.
But this one tells a completely unexpected story.
It really does, because our mission for you today is to uncover how this, seemingly unglamorous heavy machinery business is secretly riding the absolute biggest tech wave on the planet.
Yeah.
And maybe even more interestingly, how their management team is playing this highly tactical game of multidimensional chess, really, to dodge a massive regulatory roadblock coming from the federal government.
It's a masterclass. It really is a masterclass in how a traditional industrial company survives and actually thrives in a super volatile modern economy.
So before we get into the tech boom and the regulatory maneuvering, I need to clear something up. Because when I first started reading through their financials, I had a fundamental misunderstanding of what this company actually does.
Okay, what were you thinking?
Well, they are called Concrete Pumping Holdings, so I assume they made concrete. But they don't actually manufacture the stuff, do they? Like, they aren't mixing gravel and cement in a yard and selling it by the ton?
No, they don't. And that is a vital distinction to make right up front. They do not make the concrete.
Right.
They don't sell the raw materials at all. They are entirely a services provider.
Okay, so what exactly is the service? Because if a general contractor is building a massive structure, they buy the liquid concrete from someone else. Where does a company like Brundage Bone, which is BBCP's main U.S. brand, where do they step in?
So think about a modern construction site. You have a fleet of mixing trucks arriving, right? And they're full of wet concrete that is rapidly curing.
Yeah, the clock is ticking.
Exactly. You can't just dump that onto the ground, and you certainly can't drive those heavy mixing trucks up to the 15th floor of a high-rise.
Or down into a foundation pit.
Right. You need a way to move that really heavy liquid rock from the delivery truck to the precise location where it's needed, and you have to do it very quickly.
And that's the pump.
That's the pump. Concrete Pumping Holdings owns the highly specialized equipment to do that. We're talking about massive, multi-million-dollar trucks with these long, articulating booms.
They unfold like giant robotic arms, right?
Yeah, exactly like robotic arms. They can reach up over existing structures, plunge deep underground, whatever you need. So they provide the truck, and crucially, they provide the highly trained operator to run it.
Got it.
They do the job, and then their equipment returns to a home base that night.
So they are essentially an extremely heavy-duty, on-demand logistics service.
Pretty much.
They don't carry the inventory risk of the raw cement or the sand. They just own the specialized toll road, basically, that the concrete has to travel through to get to its final destination.
Precisely. And what's cool is they apply that exact same service model to the other side of the equation, the cleanup.
Oh, right. I saw that in the 10Q. They own a division called EcoPan, right? What exactly is an EcoPan?
Well, when a concrete pour is finished, you have all this leftover material, right? And you have to wash out the hoppers and the hoses.
Sure.
But that wastewater is highly alkaline. It's essentially toxic runoff. Yeah, you can't just let it soak into the soil on the job site. The EPA, the Environmental Protection Agency, would issue massive fines for that.
Makes sense.
So EcoPan comes in and provides these specialized leak-proof steel pans and roll-off containers to catch all that washout. They drop the pans off, the contractors use them, and then EcoPan brings a truck to haul the full pans away to a proper recycling facility.
So it's a fully compliant route-based service.
Yeah.
The general contractor doesn't have to worry about EPA fines. They just pay EcoPan to make the headache go away.
Exactly. So between the pumping and the waste management, you have a business that is deeply entrenched in the physical reality of construction.
Which brings us to the numbers for this second quarter of their fiscal year 2026.
Yeah.
Because I am looking at these metrics, and I am honestly a little confused.
How, sir?
Well, the top-line revenue hit $106.8 million for the quarter. That is a 14% increase year over year.
Yeah, it is a very strong quarter.
But wait, let's look at the macro environment right now. Mortgage rates are hovering near 7%. The reports I'm seeing show that residential construction is severely subdued. I mean, people aren't building massive new suburban housing tracts like they were 3 years ago.
No, they definitely aren't.
And light commercial real estate like strip malls and small office buildings, that's also taking a massive hit because debt is so expensive.
Right. And the company doesn't hide from that at all. Management explicitly states in the earnings release that they are continuing to see a slowdown in light commercial and residential demand, mostly due to those high interest rates.
Right. So if nobody is building houses and nobody's building small shopping centers, who on earth is writing the checks that drove a 14% revenue increase? Like, who is hiring all these concrete pumps?
This is where we see the hidden layer of the modern economy, because despite the housing slowdown, their U.S. concrete pumping segment saw revenue jump over 15% to $71.5 million.
That's huge. So where is it coming from?
The answer to your question, who is writing the checks, is big tech. The report points to incredibly strong activity in commercial infrastructure, specifically highlighting massive momentum in the construction of data centers.
Wow. So there's the physical footprint of the AI bill.
Yeah, it's staggering when you actually look at the engineering requirements. You just cannot run advanced artificial intelligence models without enormous computing power.
Right, the servers run hot.
Exactly. And that requires these football field-sized data centers, and you can't just put thousands of heavy server racks into a standard aluminum warehouse.
Is that because of the weight?
The sheer weight, yeah.
Okay.
Plus the required vibration control, the specialized cooling channels that have to be built right into the floors, the reinforced walls for security and climate control.
Oh, I see.
These facilities require highly specialized, heavy-duty concrete foundations that have to be poured perfectly. It is an incredibly demanding structural job.
And it requires the exact heavy-duty boom pumps that this company operates. That completely shifts how you view a stock like this. We hear endlessly about the microchips and the algorithms driving the AI revolution, but none of those chips have a home unless massive diesel trucks pump millions of tons of concrete into the ground first.
Yeah, they are entirely shielded from the housing downturn because they are surfing the massive capital expenditure wave of Silicon Valley.
And what's really interesting is how efficiently they're capturing that wave. You mentioned revenue was up 14%, but if you look a little further down the income statement, their income from operations surged 46%, hitting $12.1 million.
Yeah, it outpaced revenue growth by a lot.
Okay, hold on. Revenue grows 14%, but operating income jumps 46%. How does that math work?
That is a textbook example of operating leverage.
Okay, unpack that for me.
Sure. So in a capital-intensive business like this, you have massive fixed costs. You have to buy the trucks, maintain the home base, employ the management. But once those fixed costs are covered for the month, almost all of the revenue from every additional job drops straight down to your operating profit. Ah, because you don't need a whole new home base for one extra job.
Exactly. Because they are getting so much high-value data center work, they are squeezing vastly more profit out of every new dollar that comes in the door.
Okay, but let me push back on that profitability for a second, because I kept reading down to the very bottom line. They generated almost $107 million in revenue, but their actual net income, the final profit attributable to shareholders, was only $2.5 million.
Right.
That seems like a razor-thin margin. Where is all that cash vanishing to between the top line and the bottom line?
It's a great question, and it's why looking only at net income can be really misleading for a heavy industry. To understand where the cash goes, you have to look at depreciation and interest.
Okay.
First, those massive trucks are incredibly expensive, and under accounting rules, they lose value every year. That depreciation gets deducted from their net income, even though it isn't cash physically leaving the bank account today.
Right, it's a paper loss.
Exactly. And second, they carry a significant amount of debt to finance those fleets, so they are paying out interest. So what metrics should we be looking at to see the actual cash the business is throwing off?
You want to look at adjusted EBITDA. That's earnings before interest, taxes, depreciation, and amortization.
Okay, the classic private equity metric.
Yeah. It strips out those non-cash accounting charges and financing costs to show you the raw operational cash flow of the business. And their adjusted EBITDA was up over 17% to 26.4 million. Their margin actually expanded.
Wow. Okay.
So the core operation is highly profitable and throwing off a lot of cash.
Which is fantastic, if you happen to be operating in the United States where the tech companies are spending billions on data centers.
Choo!
But Concrete Pumping Holdings doesn't just operate in the U.S., do they?
No, they don't.
They have a major brand in the United Kingdom called Camfod. So what happens to a business like this when you operate in a region that doesn't have a massive AI infrastructure boom to bail you out of a tough economy?
That is exactly the problem management had to solve this quarter, because the UK market is telling a very different, much more difficult story right now.
Yeah, I noticed that.
If you look at their UK segment results, the environment is just brutal.
What exactly are they facing over there?
Well, the report explicitly cites severe inflationary pressures. They're seeing it on labor, on diesel fuel, and on the cost of repairing and maintaining their equipment.
Just expensive across the board.
Yeah. And you combine that with a continued softness in commercial construction demand across the UK, and their margins are getting squeezed hard. In fact, their UK operations saw their adjusted EBITDA dip down to 3.1 million.
Ouch. So the data center magic isn't happening across the pond. They are just stuck in a sluggish, high-inflation construction market.
Right.
How do you grow a company when the pie itself is shrinking?
You find a way to take a bigger slice of the pie.
Okay.
You have to extract more revenue from the jobs that actually are happening, and that requires horizontal integration. Which brings us to a major strategic move they made right at the start of this quarter, on April 1st.
Oh, yeah. I saw this, and it really threw me for a loop initially. They spent $11.1 million to acquire a UK company called Templin Hire Limited. But Templin has absolutely nothing to do with pouring concrete.
Not a single drop.
Right. Templin is a temporary power company. They rent out industrial generators. So my first thought was, has management lost focus? Like, why is a concrete pumping company suddenly dabbling in electricity?
It seems weird at first glance.
But the more I thought about the mechanics of a job site, the more it made sense. It's almost like a cable company realizing they already ran the wire to your house to give you television, so they might as well sell you the internet and phone service too.
That is the perfect analogy for what they are doing. Let's look at the actual assets they bought for that 11.1 million.
What do they get?
They acquired over 300 pieces of revenue-producing equipment. The crown jewels of this acquisition are a massive fleet of industrial generators. These range from small 20 kVA units all the way up to massive 1,250 kVA systems.
To put that in perspective for those of us who aren't electrical engineers, how much power is a 1250 kVA generator putting out?
A single unit of that size can power a hospital.
Oh, wow.
Yeah. Or, in this case, a massive commercial construction site that hasn't been connected to the main grid yet. They also bought the fuel tanks, the heavy-duty distribution cabling, and the fuel management services required to keep those generators running 24/7.
Okay, so the strategy becomes clear. Brundage Bone, or, in the UK, Camfod is already on the construction site.
Right.
They already had to go through the lengthy sales process to win the contract with the general contractor. And that general contractor needs concrete pumped, but they also desperately need temporary power to run their cranes, their lights, their site offices.
Exactly. Before, Camfod would pump the concrete and leave. Now they can walk into the general contractor's office and say, hey, we can handle the concrete logistics, and by the way, we'll supply all the temporary power for the site for the next 6 months.
Right.
It transforms them from a single-task vendor into a comprehensive site infrastructure provider.
You are just adding more high-margin items to an invoice that you were already going to send anyway.
Exactly.
And did it work? Like, did Templin actually move the needle for them?
Immediately. The 10Q notes that for the single month they owned Templin during this quarter, it contributed $0.7 million in fresh revenue.
It's just in 1 month.
Yep. It is instantly acting as a new growth engine to help offset the sluggishness of the broader UK market.
That is a really clever pivot. But, as fascinating as that UK acquisition is, my absolute favorite part of this financial report is what's happening back in the United States.
Oh, the regulatory stuff.
Yes, because it reads almost like a corporate thriller. While they are playing offense in the UK by acquiring new businesses, in the US, they're playing a fierce game of defense against the federal government.
You were talking about their capital expenditure strategy.
Exactly. Hidden deep in the management commentary is this incredible little detail. The company is actively pulling forward $22 million of planned capital expenditures.
That's a lot of cash.
Right. Money they were planning to spend in the calendar year 2027. They are rushing to spend right now in 2026.
It is a massive allocation of capital.
But why? Why on earth would a company rush to spend $22 million a year earlier than they have to? In business, you usually want to hold onto your cash as long as possible. What exactly are they running from?
They're running from the Environmental Protection Agency. Specifically, there is a strict new set of U.S. emissions laws taking effect on January 1st, 2027. These new regulations apply to all heavy-duty diesel engines manufactured for the 2027 model year and beyond.
And BBCP's entire U.S. operation relies on a massive fleet of heavy-duty diesel trucks.
Yep.
So when management looked at this 2027 deadline, they realized they were walking into a trap if they just stuck to their normal, leisurely schedule of replacing old trucks.
They were facing two massive interconnected headaches. The first headache is simply the sticker price.
Because the truck manufacturers aren't just going to absorb the cost of these new EPA rules, right?
Of course not. I mean, the original equipment manufacturers, the OEMs who build these highly specialized truck chassis, they have to spend a fortune on research and development to entirely redesign their engines to comply with the 2027 standards.
Sure.
They are absolutely going to pass those incremental production costs straight on to the buyers, which means a 2027 model year truck is going to be significantly more expensive than the exact same truck built in 2026.
So pulling the $22 million forward is a hedge against regulatory inflation. They're basically locking in the lower 2026 prices before the EPA mandate forces the prices up.
That's the financial angle. But the second headache is actually far more terrifying for an operations company.
What's that?
It's about reliability. The SEC filing explicitly mentions that they are trying to navigate expected disruptions from first-generation truck technologies.
Oh, right. Because whenever the government forces a massive mandatory change in engine design, history shows us that the first generation of those new engines is usually full of bugs.
Exactly. They haven't been stress-tested in the real world for millions of miles yet. They break down more often. They spend more time in the repair shop while mechanics trying to figure out entirely new diagnostic codes.
And for a concrete pumping company, downtime isn't just an inconvenience. Like, if an Amazon delivery van breaks down, the packages are late. But if a concrete pump breaks down in the middle of a massive pour,
The concrete hardens inside the multi-million-dollar equipment.
oh man.
Or you ruin the structural integrity of a data center foundation because the pour wasn't continuous. It is an operational disaster. They only make money when those booms are in the air.
So by spending that $22 million right now, they aren't just saving money on the sticker price. They are actively avoiding first-generation engine bugs.
Exactly.
They are filling their fleet with proven, reliable 2026 technology that they already know how to maintain.
It is a ruthless and brilliant competitive move. Think about the smaller, regional concrete pumping companies they compete against. Those smaller rivals probably don't have $22 million lying around to front-load their fleet upgrades.
So the smaller guys are forced to wait until 2027.
Yep. And when 2027 hits, those smaller rivals are going to be stuck buying vastly more expensive trucks that are breaking down and ruining their client relationships.
Yeah.
Meanwhile, Concrete Pumping Holdings sails through the regulatory change with a cheaper, highly reliable fleet.
It is tactical capital allocation at its finest.
Mm-hmm.
But, to pull off a maneuver like that, you need serious financial muscle. You can't just conjure up $22 million in cash out of thin air.
Yeah.
So how are they paying for this?
Well, let's look at their balance sheet, because their liquidity position is incredibly strong. As of the end of this quarter, they had total available liquidity of $346.3 million.
Wow. Okay, that gives you a lot of flexibility.
Yeah.
But they do carry debt, right? Heavy equipment requires heavy financing.
They do. They carry a total gross debt of roughly $425 million. But the structure of that debt is really important. The vast majority of it is locked up in senior notes that carry a fixed interest rate of 7.5%.
Ah, so they aren't getting squeezed by the current fluctuating interest rates.
Right. And even better, those notes don't mature until February 2032.
Plenty of runway.
Tons of runway. They also have access to an asset-backed loan facility with a massive capacity of which they've barely drawn anything. So when you look at their net debt compared to the actual cash the business generates, their leverage ratio, it sits at a very manageable 3.8 times.
So they are generating so much free cash flow from these data center jobs that they can afford to play the long game. In fact, they have so much cash that they aren't just buying trucks and acquiring UK power companies, they're also buying up their own stock, right?
Yeah, and that's a huge signal of management's confidence.
Hmm.
During the second quarter alone, they repurchased almost 400,000 shares of their own common stock on the open market.
How much did they spend on that?
They spent about $2.6 million at an average price of $6.68 per share.
So they clearly believe their own stock is currently undervalued by the wider market.
Absolutely. If you look at the entire 6-month period, they've actually bought back over 1 million shares. And they just extended their authorized share repurchase program, which allows them to buy back up to $50 million worth of stock all the way out to the end of 2026.
It really paints a complete picture of a company that is in total control of its own destiny, despite a turbulent macroeconomic environment.
And that confidence translates directly into their forward-looking projections. Because of how strong this first half of the year was, management actually used this earnings release to raise their full-year financial outlook.
They bumped up the expectations across the board, didn't
They did. They originally told Wall Street to expect full-year revenue somewhere between $390 and $410 million. They've now raised the floor and the ceiling on that, targeting a new range of $410 to $425 million.
And what about for the operational cash flow, the adjusted EBITDA?
They raised that target up to a new range of $98 to $105 million. They also increased their free cash flow expectations, noting they expect to generate at least $45 million in free cash flow this year.
That's solid. And the most incredible part of that raised guidance is that they explicitly state they are achieving these numbers while assuming that the light commercial and residential construction markets will absolutely not recover this year.
Yeah, they're fully writing off the housing market entirely, and they're still raising their revenue targets.
Because the infrastructure boom is just that powerful.
It really is. I think this deep dive really proves a vital point about how we view the modern economy. If you want to understand the technological revolution, you can't just look at the flashy software companies in Silicon Valley.
Yeah.
You have to look beneath them. You have to look at the businesses providing the heavy machinery, the raw materials, and the highly technical, unglamorous services that make the physical footprint of that technology possible in the first place.
It brings us right back to the image we started with. We are endlessly bombarded with news about artificial intelligence, cloud computing, and the digital future. But as Concrete Pumping Holdings proves, none of that digital magic can exist without diesel engines, temporary power generators, and massive boom trucks pumping millions of tons of concrete deep into the earth.
Exactly.
So as you watch the tech sector continue to boom and reshape our world, it leaves you with a fascinating question. What other invisible heavy-duty industries are secretly powering our virtual lives, just hiding in plain sight?